They said the credit crisis of 2008 was a once-in-a-century event, a perfect storm that would never repeat. The regulators were supposedly smarter, the banks supposedly safer, the policies supposedly stronger. But what if that was wrong? What if, behind closed doors, America's second-largest bank quietly admitted the system is breaking again? What if a leaked internal report from Bank of America reveals a darker, urgent picture, one that completely contradicts the reassuring public narrative? A report warning that consumers are cracking, bank lending is freezing, corporate defaults are accelerating, and a silent credit contraction has already begun. And the most disturbing part, this is the story of a leak. Wall Street tried to bury one that exposes how the credit crisis never truly ended. Tonight, we walk through the leak, its hidden origins, the pressures they're built for over a decade, and the consequences now unfolding in slow motion. This is a financial thriller where every chapter pulls you closer to a truth the system dose and tea want you to see. This is Bank of America's secret report. Leaks credit crisis is back. To understand what Bank of America secretly revealed, you first need to understand the machine that keeps producing these crises. It isn't just the economy. The credit system is a massive, fragile organism with many parents. The Federal Reserve, Wall Street megabanks, corporate giants, politicians, consumers, and a global financial architecture built entirely on debt. Jobs rely on credit. Government spending relies on credit more than any entity in human history. Over $100 trillion in total credit depends on one thing. Once lenders hesitate, once borrowers panic, once households struggle, the structure begins to crack. And for the last decade, this confidence was artificially inflated by zero interest rates, unlimited liquidity, trillions of stimulus dollars, and banks encouraged to lend recklessly. For years, everything looked normal, stable, strong, growing, until it wasn't. The origins trace back to 2009, right after the collapse of Lehman Brothers. America was traumatized. The banking system was on life support, and the government had only one real solution: make borrowing cheaper than ever. The Federal Reserve cut interest rates to zero. By 2023, household debt hit all-time highs in every category. Credit card debt at $1.6 trillion, auto loans at $1.7 trillion, student loans near $1.7 trillion, and mortgages over $12 trillion. Banks began pushing new forms of subprime lending, subprime auto, subprime personal loans, subprime credit cards, buy now, pay later debt, all packaged and securitized just like before the 2008 meltdown. Corporate America went on a borrowing binge kept alive by cheap money that turned thousands of companies into zombies alive on the surface, dead underneath. Meanwhile, the government's debt exploded past $34 trillion. The entire financial system became addicted to cheap borrowing, unable to survive without it. But when the Fed finally raised interest rates, the bubble began to fracture. As interest rates climbed at the fastest pace in 40 years, pressure began building inside the financial system. Consumers saw their minimum payments rise. Banks quietly tightened their lending standards. Inside Bank of America, data analysts and risk officers watched the numbers shift from concerning to dangerous. And here's the key: the alarms were flashing behind the scenes, but not publicly. The bank was warning investors or regulators, but internally, they were preparing reports filled with mounting evidence of a crisis, reports mapping rising delinquencies, collapsing loan demand, accelerating credit defaults, shrinking household savings, regional banking vulnerabilities, and early signs of systemic weakness not seen since 2007. These internal updates weren't designed for the public. They were designed for executives, risk committees, and the quiet rooms where the real decisions are made. Eventually, one of these internal reports leaked, and the picture it painted was far darker than anything Bank of America ever admitted publicly. The leak did not explode on social media. The first major revelation was that American consumers had exhausted their pandemic savings far earlier than government data suggested. Internally, Bank of America estimated that savings had fallen to 2017 levels and that nearly 40% of low-income families had less than $100 left. Credit card utilization hit the highest level ever recorded. The bottom 60% of Americans were living with negative cash flow. People weren't using credit to elevate their lifestyle. They were using it to survive. The second revelation was worse. Credit card delinquencies were rising faster than during the lead up to the 2008 crash, Internal models showed 90-day delinquencies climbing at twice the speed seen before the last financial crisis, and charge-offs accelerating months earlier than expected. Subprime borrowers, according to the bank's analysis, had entered unrecoverable financial stress. This directly contradicted public government statements claiming the consumer is strong. The third revelation was that banks across America not just were quietly cutting off credit. While CEOs assured the public that lending remained strong, internal data showed credit limits being loan application approvals falling, and small businesses losing access to credit lines. In private, banks were preparing for a contraction. In public, they were pretending everything was fine. Over $2 trillion in corporate bonds were coming due, with most companies unable to refinance at today's higher interest rates. The internal report warned that a wave of corporate bankruptcies was inevitable under current conditions, something that would spill into layoffs, defaults, and contagion across the lending markets. But the most important sentence in the entire leak was a single line. The structural conditions for a credit crisis similar to 2008 have reappeared. In other words, the crash had already begun. You're so done teasing the headlines yet. Once analysts reviewed the leaked report, they began comparing it with data from other banks, federal reports, and market signals. The evidence was consistent everywhere. The Fed's rate hikes had broken the consumer, credit markets were freezing, corporate defaults were accelerating, and smaller regional banks were losing deposits at dangerous speed. Lending was collapsing across nearly every category: auto, loans, mortgages, credit cards, commercial real estate, and small business lending. This wasn't a future prediction. It was an active crisis. But here's the most concerning point. Historically, when credit markets break, the solution is simple cut interest rates. But this system is trapped. Inflation remains too high, government debt too massive, and lowering rates risks igniting a new inflation wave or triggering a currency devaluation. If the Fed raises rates, the credit crisis accelerates. If they cut rates, inflation returns. That is why Bank of America's internal assessment matters. It proves the crisis is not looming, it's already in motion. History shows this pattern clearly. In 2006, subprime delinquencies rose and regulators ignored them. In 2007, banks tightened credit, economists claimed no recession in sight. In 2008, consumers cracked firsthand, then the banking system imploded. Rising delinquencies, tightening credit, shrinking savings, corporate refinancing stress, and quiet instability within regional banks. The difference is scale. Today, the US has $1.6 trillion in credit card debt alone. Every number is larger, every system more fragile, every pillar more interconnected. History isn't repeating, it's escalating. The Bank of America leak is not a prediction or speculation, it's a diagnosis. The patient is already sick, and the symptoms are worsening. The public narrative of a strong consumer and a stable system is a facade. Behind closed doors, banks are bracing for impact. Regulators are adjusting stress models. Credit risk departments are watching defaults climb like a pressure gauge rising past the red zone. The warning signs are not subtle. There are three major takeaways from everything uncovered. It isn't a distant threat, it's unfolding beneath the surface right now. Second, consumers will be the first domino. Once households break, businesses break, banks break, and eventually governments are forced into extreme policy responses. Third, the system is too fragile to handle high interest rates, yet too risky to allow rates to fall. The final warning is simple. When the next major financial headline appears, it won't say credit crisis coming, it will say credit crisis already here, and when that moment arrives, it will already be too late to prepare. If you found this breakdown valuable and want more deep dive financial investigations, the mainstream ones you talk about, make sure to like this video, subscribe, turn on notifications, because the truth is unavoidable. You cannot fix what you refuse to see.